today's presentation. My name is Peter Yusuf, Senior Analyst at IronFX. Welcome to today's presentation. We're going to be mixing technicals with fundamentals today. It's expected to be a heavy week ahead. However, I would be noting here that it's a rather light Monday. And we make a start with Euro USD. This is the daily chart. Mind you that all charts we presented are to be at the same time frame unless otherwise stated. We are going to be going through the charts of major pairs and add a couple of US stock market indexes. Possibly, if we have time, we'll have a look at WTI as well, maybe even gold. Now, should you have any trading instruments you would like to have a look at, feel free to add them in the comment sections. If we have time today, we'll definitely have a look at them today. Should we not have time today, we could have a look at them tomorrow. Now, starting with Euro USD. Okay, we saw a dropping of the pair during today's Asian and early European session. I would be noting here that the drop of the pair practically reversed the gains made of the pair on Thursday and Friday. And the big question arises here, is the drop actually shifting the downward trend line to the right or not? What we're discussing here is practically whether this is happening or if the trend line we have mentioned was correct and it has been broken. And the reason I'm stating this is because it seems that bearish tendencies for the pair have been rejuvenated. On the other hand, though, the RSI indicator tends to disagree and remains flat at the reading of 50, implying a rather indecisive market, which could allow the sideways motion between the 1.086 and the 1.0815 being maintained. So practically the price action is within the boundary set of the sideways motion. On the other hand, though, I wouldn't be so sure that the sideways motion is to be maintained. The downward motion is quite intense. And the American session has still to start, so we may see an intensification of the strengthening of the US dollar, which in turn could drive Euro USD far lower. For a bearish outlook to emerge, I would require the pair to breach the 1.0815 support line right here. So the price action has to drop, breach the S1, and start aiming for the S2 1.0765. On the flip side, should the bulls take over, which seems a bit remote right now, but it's still a possibility and it should be covered. In such a case, we may see the pair reversing direction, breaching the prementioned downward trend line even clearer, but most importantly, it has to breach above the 1.0860, have a higher peak than these ones. So the price action has to breach the R1 and start actively aiming for the R2 1.0915. Definitely a recalibration of the pair could be in the cards, but I would sit this session out and wait for tomorrow before I recalibrate, especially the resistance levels. They could go a little bit higher. Okay, let's have a look at USD/JPY, which had been dropping on Friday, and that seems not to be the case. Let me shift this to the right. There you go. We have the price action, which is currently testing the R153.6, a level that was breached on Thursday, but the pair corrected higher once again. Here we're going to be needing definitely a recalibration of the pair's resistance support lines, and I'm going to be highlighting first of all this one, Note how the S1 is 150.90. And I'm mentioning this level because we had, allow me to insert a circle within it in order to highlight it. We had one touch here, another touch here, and we had continuous tests to the upside right here, and we had another touch, I would be noting it as well, right here. So we have 1-2 touches to the upside and 1-2 touches to the downside. It's a very well tested level, and it's about 10 pips higher than the previous one. So I'm going to be setting the S1 at 151.90. Let's set the new resistance lines. Note the touches here, here, and here. That would be the 154.75. I'm keeping definitely the R2, and I'm keeping it because it had a beautiful touch here and a beautiful test here, as well as the R3. It's an all-time high. We cannot mess with that. Let's have a look at the support lines. I'm going to lower the S2 at 145.85 with one touch here and here, and going to be reversing. Note the support line. I'm highlighting this because you had touches to the upside here, touches to the downside here. Also, it was used as a platform to move higher. That would be the 148.85. So let's correct also the labels. I remove that. Let's widen this so we have better view. The R3 161.90 remains unchanged. The R2 we have corrected that already. The R1 also. The S1 here. The S2 at 148.85. And the S3 at 145.85. We have narrowed the distance between the levels substantially, and we have practically recalibrated the pairs resistance support lines in order to better reflect the turning points of the upward and downward movement on the chart, which are more recent. And now we're relying far less on past turning points. So I consider fresher points to be somewhat of more valid than earlier ones. And it tends to highlight exactly the presence of buyers and sellers in the market. Now, as for direction, we tend to maintain a bearish outlook for the pair. I would have some doubts, and those are related mostly to the movement of Thursday. It's the fact that the price action on Thursday had a steep drop. Note how it had breached the low Bollinger Band, dropped as low as the 151.90, and then corrected higher, practically almost like a dodgy candlestick. It's not exactly a dodgy candlestick with a long tail, but still the correction was substantial, and it was within a day. So that was quite impressive, which verified also the validity of the S1 as a level. The following 2 days, that would be Thursday and during today's Asian session and European, were in the reds, but the width of the bearish movement is far narrower if compared to Wednesday and Tuesday. And that tends to imply that we may be seeing a slight hesitation on behalf of the bears to actually continue to drive the pair lower. Practically, the fact that neither on Friday nor today the pair was able to retest or even breach the S1 tend to serve as signs of a possible hesitation of the bears for the pair. On the other hand, I would be highlighting also two other elements which tend to corroborate the bearish outlook of the pair. The one would be the fact that the price action on Thursday corrected after breaching the lower Bollinger Band. And that was something which happened for a second day in a row, which was screaming practically for a possible correction higher. It did. And it did correct higher, but it did not breach the downward trend line, which is currently still guiding the pair. And may I add here that the price action now has some slight distance between itself and the low Bollinger Band, which may allow for some room for the bears to play. That's one. The second element I would be highlighting for a possible bearish outlook would be the fact that the RSI indicator is at the reading of 30, highlighting the strong bearish sentiment of the market for the pair. At the same time, though, maybe also implying that the pair has reached oversold levels and may be ripe for a correction higher. Now, the key, or if you prefer, the crucial part for a change of direction would be the breaking of the downward trend line. As long as the downward trend line remains intact, we maintain a bearish outlook for the pair. Should the pair's price action breach the downward trend line as mentioned, yet respect the R154.75 and the 151.90, then we're talking about the possibility of a sideways motion emerging. For a bullish outlook, we would require the pair to initially breach the mentioned downward trend line, signaling the interruption of the downward motion, and that would be the first signal. But for bullish outlook, I would require the pair also to breach the R1 154.75 clearly and start actively aiming nearing the 157.70 support line. Should the bears maintain control, as we have mentioned, we expect the S1 151.90, however difficult it may be, to be breached. And in that case, the way would be paved for the S2 148.85. That's a level which provided practically some resistance in the past. You can see it right here, but also some support and served as the low boundary of the past sideways motion of the pair. Okay, that should be about it. Fundamentally, definitely JPY traders are focusing on the release of BOJ's interest rate decision. That would be on Wednesday's Asian session. The bank is not widely, but the market seems to be pricing in a possible rate hike, which could provide some support for JPY. I would be noting that, in my opinion, the Japanese CPI rates seem to be a little bit more sticky than expected, which actually corroborates with the narrative of BOJ that more rate hikes are required, even small ones of 10 basis points. And should we see the bank actually hiking rates and maintaining also a possible more hawkish accompanying statement, implying that there may be more rate hikes to come, then I would expect the JPY side of the pair to strengthen. Mind you that the JPY side of the pair may also be influenced by safe haven inflows. There are very few right now, but it's a possibility, especially should there be wider escalation of the conflict in Israel with the Palestinians. May I add here that Israel seems to be preparing for airstrikes against Hezbollah positions in Lebanon. Should that be also accompanied by troops movement on the ground, that could create, or if you prefer, intensify market worse and create safe haven inflows for the Japanese currency, which could drive USD JPY even lower. Let's have a look at GBP USD. Now we have to work our way from the start. This is the daily chart of cable. Definitely we have a resistance line right here. Let's color this in red. And that would be the 1.3040. Locking it in. Another resistance line right here on this peak. One could argue another one where the price action is actually at right now. I'm going to go a little bit lower on this support line here. And that was also a former resistance line. And set it as a support line. 1.2775 in green. I'm going to go further lower for the second support line. You can see the trough here. And these testings here and here seems to be pretty valid as well. That would be the 1.2610. One could drive it lower to the 1.26. I wouldn't say no here. Moving now to the lowest level in our chart, not in our chart, and as for support lines, would be the 1.2450. Definitely this true here was interesting and cannot be neglected. And S4 could be added right here. Now we have left out the third resistance line. Let's go hunting. And we have one right here. It's a peak which practically cannot be ignored. We're talking about the 1.3140 resistance line in red. There you go. Readjusting the chart, widening a little bit. Let's add some labels so we have a clearer view. R3 at 1.3140. The R2 100 pips lower at 1.3040. The R1, we should round it up, this one, at 1.2890. Let's have a look whether that's, yeah, 1.2890. The S1 at 1.2775. The DS2 at 1.261, and DS3 at 1.2450. Locking everything in. Let's talk direction. Now we get some conflicting messages. On the one hand, we have a clear-cut downward trend line guiding the pair, so the bearish outlook is present. On the other hand, I have to note here that the only corrections made were almost not felt by the price action's downward motion. I would be also noting here that the price action over the past 1, 2, 3, 4, 5, 6, 7, 8 days, despite these two corrections, is to the downside. The RSI indicator seems to be disagreeing, despite having a clear downward slope. I would be noting that it still has some difficulty to breach materially below the reading of 50, implying a rather indecisive market, which may stabilize the pair somewhat. So for the time being, we maintain a bearish outlook for the pair, given that it has also breached the 1.2890 support line, now turned to resistance, and even used it as a resistance during today's Asian session. However, I would be also issuing a warning about the possible stabilization of the pair. Should the bears maintain control, I would expect the price action to breach the S1 1.2775, with the next possible target for the bears being the 1.2610 support base, which is resting on this true right here. Should the pair stabilize somewhat, I would expect the price action to respect the R1 and the S1. While should the bulls take over, or if you prefer for bullish outlook, I would require the pair to initially breach the downward trend line we have mentioned, which would be the first sign that the downward motion has been interrupted. But also I would require the pair to breach the R1 1.2890 and start actively aiming for the R2 1.3040. It's important that it rises substantially above the R1. Now on the fundamental side, okay, we have definitely BOE's interest rate decision on Thursday, which is expected to captivate GBP traders. Today, it's expected to be a rather easy day for pound traders, yet I would still be highlighting two events. The first would be the release of the CBI distributive trades. That should be out in about half an hour. A possible improvement of the indicator, it was at minus 24, and it relates to the retail sales in the UK. It seems that most retailers still expected a drop of retail sales in the past month, and should that be maintained or even wider, be the figure even wider to the downside, that could weigh on the pound. The second issue I would be highlighting would be the speech of UK Finance Minister, or the official title is Chancellor of the Exchequers, MS Rachel Reeves. Now, she's expected to provide a picture of what she got from the previous government, Rishi Sunak, and the state at which the UK economy is in. Most probably, she will be painting a grim picture. There will be no kind words for Rishi Sunak's government. Most probably, they will be pretty harsh. And should that be the case, we may see also some backstepping on some initial pre-election promises of the government, which could weigh on the pound somewhat. It all depends, or if you prefer, it all comes down to how harsh the criticism will be and how that could disappoint pound traders and actually drive the pound even lower. Now, as for BOE's interest rate decision on Thursday, I would expect the market to start positioning itself ahead of the release, possibly even from tomorrow on. Mind you that the market, not marginally, but definitely not substantially, it seems to be pricing in a possible rate cut in the bank's next meeting. The fact that the headline CPI rates dropped to the bank's 2% target tends to justify possible rate cut by BOE. So should that be the case, we may see the pound weakening. Yet once again, we may see substantial weight on behalf of the market being placed also on the accompanying statement. The bank expects another rate cut within the year. And should that not be reflected also in the accompanying statement, or at least an intention to do that, or some dovish predisposition of the bank, then we may see the pound getting some support, because the market will have correctly predicted or expected the rate cut on Thursday, but will have to reposition itself in regards for a possible October rate cut. Here, let's have a look at the Aussie. Oh, now that's an interesting chart. On the one hand, we have a steep drop of the pair, that's evident. Note also that the inclination of the downward trend line has intensified to the downside, but on Friday it corrected higher. It was the first correction, the first day in the greens for AUD USDs for the past 1, 2, 3, 4, 5, 6, 7, 8, 9 days. Ladies and gents, this is substantially bearish, but the correction tends to set some doubts. On the other hand, though, I would be noting that the pair corrected high after materially breaking the lower Bollinger Band and seems to be rather undecisive during today's Asian and early European session. On the other hand, though, note that the RS indicator remains pretty low. It remains at the reading of 30, implying a strong market sentiment on behalf of market participants for the pair, which could drive the pair even lower. On the flip side, maybe also implying that the pair is at oversold levels and may be ripe for a correction higher or even some slowing down of the bulls. That, if the bearish movement is maintained in the following 2 or 3 days, would be able to possibly shift the downward trend line a little bit to the right. For a bullish outlook, I would require the pair to rise, breach the pre-mentioned downward trend line, breach the R1 0.6575, and start aiming for 0.6710. Actively aiming. Let's have a look at USD CAD. The same picture in the reverse. On this point, allow me to shift the upward trend line to the right a little bit. Now, we have an interesting element here. And on the one hand, we have an intense upward movement, which is underscored by the upward trend line, but also highlighted by the RSI indicator, which is at the reading of 70, implying a strong bullish sentiment on behalf of the market, which could drive the pair even higher. On the flip side, again, it could be implying that the pair is at overbought levels and may be ripe for a correction lower. The second element I would be noting would be the difficulty of the pair to breach the 1.3845 resistance line. It has tested that level 3 times in the past 3 days, and allow me to drill into the 1-hour chart just for the look of it. You can see 1, 2, 3, and it was not able to breach it. Back to the daily chart, and that tends to create some worries about the bullish outlook. As long as the upward trend line though remains intact, we maintain our bullish outlook. Now, should the pair stabilize, I would expect the price action to breach the pre-mentioned upward trend line exactly in the first signal that the upward movement has been interrupted. And should the bears take over for a bearish outlook, I would require the pair to breach the S1 1.3590. Nothing less. For me, it has to go all the way down. It has to give back 240 pips of bullishness. Reverse the losses, the gains of the past 9 days or so, 10 days. I know it's a little bit conservative, maybe a little bit out of proportion, but for a definite bearish outlook, I would require a breaking of the S1 and the price action to start aiming for the S2 1.3475. Now, at this point, it's interesting to note what the Fed will be doing on Wednesday. Now, the bank is expected widely to remain on hold. However, the market prices in prices in 3 rate cuts until the end of the year. One in September, in November, and one in December. So the market's predisposition is quite, or if you prefer, very dovish. Should the Fed's accompanying statement fail to support these dovish expectations of the market, we may see the USD gaining substantially, which may push USD CAD far higher. On the flip side, should the Fed indicate in its accompanying statement that it's prepared to cut rates extensively until the end of the year, I wouldn't be surprised to see the USD weakening substantially, breaking the upward trend line and allowing USD CAD to start forming a bearish outlook. Let's have a look at the US stock market, starting with S&P 500. Now this is an interesting chart. Despite some uncertainty, the price action, let's drill to the weekly chart. Price action is now testing the final upward trend line. Let's clear it just to get a better picture of it. And it has breached also the 5490 resistance line, now has to be turned into a support line. So we tend to maintain a bullish outlook for the index and set the next possible target for the bulls at the 5590. That was a level which was aimed for once, twice, and somewhat used here as well, creating some commotion. On the flip side, should the bears take over, the price action has to drop below the 5490, breach the pre-mentioned upward trend line. But I would also require the index to breach the 5370, a former resistance line. You can see the peak right here supporting it, and start aiming for low grounds. The RSI indicator is on the rise and nearing, it's still below it, but nearing the reading of 50, which may imply on the one hand that the bearish sentiment is fading away, yet it doesn't necessarily mean that the bullish sentiment is being built up here. So be a little bit on your guard. We may be seeing for the time being some hesitation upon the rise of the index. I think that we will be getting a clearer picture during the American opening today. Let's have a look at WTI. Oh, that's interesting. Now, oil prices are edging lower, but if we drill into the 1 hour chart, notice the positive gap at today's opening. That was maybe created by some uncertainty regarding the conflict in Israel. Because should the conflict intensify or escalate further, then we would be talking about a possible tightness in the supply of the international oil market, which could drive oil prices higher. Back to the daily chart, bearish tendencies though still present, and as despite opening with a positive gap, the price action is lowering itself and nearing the S175.50. As long as the downward trend line remains intact, we maintain our bearish outlook. And I would expect the price action to breach the 75.50 and start aiming for the 72.40. Last but not least, let's have a look at gold. Ladies and gents, despite a rise over the past week, we saw Friday ending with practically a doji candlestick, and today during the Asian and early European session edging lower. I would like to have a look at it also with the US index, which we do not have open right now. But overall, I think that the negative correlation between the US dollar and gold's price is still in effect. I would be noting also the expansion of the downward trend line, like here. If that's the case, then expect the price action of gold to drop, breach the 2384 and start aiming for the 2350. But, and I'm highlighting this, the RSI indicator has risen for the depths of the reading of 30 and is now running along the reading of 50, implying a rather indecisive market, which may allow for some stabilization for gold's price. In such a case, expect the downward trend line, which we have just shifted to the right, to be breached, and the price action to extend its sideways movement, possibly just above the 2384 level. That should sum it up. From all of us here at IronFX, best wishes for solid trading.
Before we kick things off, let's quickly go through the risk warning and disclaimer as well. Do take note that all the products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. Right? These products may not be suitable for everyone, and you should ensure that you understand the risk involved. All right, do take note of the disclaimer as well. The information in this webinar should not be considered investment advice or investment recommendation, but instead educational material only. All right, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. All right, so today's webinar series will be the first part of the Fibonacci series. So we'll be looking at retracements. So we'll start off with the basics, of course. We'll look at how do we identify an ideal market structure? How is it different from something that's non-ideal? Why is that important? Because when we are trying to use the Fibonacci retracement tool, we should be looking for ideal market structure or something that resembles as closely as possible to an ideal market, right? Being the real life world, nothing's ever ideal when it comes to market structure or price action, but we are going to look for something that's going to be as close as possible to the ideal structure. Then we will look at how we can follow the market structure so as to achieve good or to achieve significant Fibonacci retracement levels, right? When we do not use the Fibonacci retracement tool correctly, and when we do not follow the market structure as closely as possible, then the retracement levels that are highlighted by the Fibonacci retracement tool will not indicate significant resistance or support levels, right? So that's the basics. We are going to identify what is an ideal market structure, what type of price structure in reality mimics the ideal market structure, and then how to follow that, and how do we draw the Fibonacci retracement from the starting point to the end point. Then we'll also look at the various Fibonacci retracement levels. Then we'll also touch on the negative Fibonacci levels as well as the levels that are greater than 100%. All right, so if you have any questions along the way, do not hesitate to drop your questions in the Q&A box or the chat box. I'll be more than happy to go through your questions should there be any doubts along the way. All right, so let's start off with the ideal market structure. What is an ideal market structure? Well, first of all, we'll start off by looking at what is wrong, right? Okay, so when we are trying to draw a Fibonacci retracement, we're looking for significant swings, right? So we're looking for market swings, so like a swing high or a swing low, right? In this example here, what we are seeing, this GIF is showing us an example of insignificant swings, right? So you can see here, I'll just label it. This is number one. This is number two, right? So swings like these are pretty insignificant, right? And also here, looking at here, three, this is a swing high, 4 and 5, right? When you look at 1, 2, or even this one here, let's label this 6. You can see this swings, all these swing highs here. These are the highs. They're all pretty insignificant. So we're not looking for these sort of insignificant swing highs, right? Similarly, when we look for the swing lows, you look here, A, B, C, D, right? These are insignificant swing lows, right? So we're not looking for this type of market structure where the swing highs and swing lows are insignificant. This is pretty noisy, right? To a certain extent. So what we're looking for in a market structure that will have significant swings. Now, this can be swing highs and swing lows, of course, right? So now that we've had an example of what is or what are insignificant swings, let's move on and try and see how do significant swings actually look like, right? Okay, now here we have a GIF showing us examples of how to identify significant swing highs and significant swing lows, right? As you can see here, we need to look for significant swing highs and lows. So clearly we can see here, point number one is a significant swing high. Point number two here is a significant swing low. Point three is another significant swing high. Point four is another significant swing low. Point five is a high. 6 is a low. 7 is another high, right? So this GIF is clearly illustrating how do we identify significant swing highs and lows in market structure, right? So you can clearly see this is a swing high here, 0.1. This is a low, high. Number 4 is a low, 5 is a high again, 6 is another low, and 7 is a high, right? So do take note. This is how, this is a type of market structure that we're typically looking for when we're trying to identify swing highs and swing lows, because that's very important. That's basically the main foundation of Fibonacci retracements. We need to identify the significant swing highs and swing lows so that when we actually use the retracement tool and we draw the Fibonacci retracements, we are going to get retracement levels that would actually function as, or that would potentially function as very significant resistance or support levels, right? So what we're trying to do is increase the probability of these retracement levels functioning as a significant support or resistance, right? If you don't draw the Fibonacci retracement in the correct manner, the subsequent retracement levels are very likely not to yield any significance, right? Be it as a support or resistance, okay? Right. Now, how do we follow the market structure? Right now that we've identified significant swings, highs, and lows, now how do we identify, how do we follow the market structure when we use the Fibonacci retracement tool? So as we can see in this GIF here, 0.1 is clearly a significant swing low. That's fine. That's great. 0.2 is also a significant swing high. 0.3 is another significant swing low. And 0.4 is another significant swing high. But in this example, they're drawing the Fibonacci retracement starting from 0.1, but going all the way up to 0.4. As you can see here, the highlighted diagonal line, right? You can see the highlighted diagonal line is going to come up again. Now that highlighted diagonal line in blue, that is the trend line of the Fibonacci retracement tool, right? Fibonacci retracement tool. So when we start Fibonacci retracement, we always start from the left to the right. So when we're doing it for the upward part of the move, we're always going from bottom left to top right. Similarly, when we draw the Fibonacci retracement for the downward move, we're going to go from top left to bottom right. So do take note, this is another key aspect of how to use the Fibonacci retracement tool. We always go from left to right. So if it's an uptrend, if market structure is going up, right, we always go from 0.1 on the bottom left to 0.2 on the top right. Similarly, when we have a market structure that's showing a strong downturn, we're going to go from 0.3 to 0.4. That means we're going to go from top left to bottom right. Remember, Fibonacci is always left to right. Yeah. Whenever we are drawing the Fibonacci retracement tool, be it for the upward move or the downward move, we always go from left to right. So for the upward move, for the uptrend, we're going to go from bottom left to top right. And for the downtrend, we're going to go from top left to bottom right. Okay, that's another key aspect of using the Fibonacci retracement tool. All right, now going back to that trend line, remember I was talking about that this, yeah, can you see here, this highlighted in blue, this trend line. Now in this example, they've started this Fibonacci retracement starting from 0.1 and ending it at 0.4. We can clearly see that the trend line is not capturing the market structure at all, right? We can see that there's plenty of gaps to the top of the trend line as well as to the bottom of the trend line. So in this type of market structure, the ideal Fibonacci retracement, right, to be drawn would be from 0.1 to 0.2. So when we draw it from 0.1 to 0.2, we can see that the trend line will capture the market structure much better than from 0.1 to 0.4. Similarly, when we're doing it for the downtrend, we'll start from 0.2 to 0.3. And when we do that, the trend line will capture the market structure very closely. So that's what we're looking for. We're looking for the trend line to capture the market structure as closely as possible, be it to the upside or to the downside. So that's how we know whether we've drawn the Fibonacci retracement using the correct starting and ending points. Do take note, if the trend line does not capture the market structure very well, that means it's quite likely we have not used the ideal starting and end points for the Fibonacci retracement, right? Okay, let's go on to the next slide. Now here, we can see we've identified point 1 and point 2. Point 1 is the starting point. Point 2 is ending point. And you can clearly see that the blue trend line has captured the market structure as closely as possible. Of course, there are going to be a little bit of gaps to the downside and to the up of the trend line, but in general, we can see that this trend line has captured the market structure very well. Now, similarly, if we had drawn the Fibonacci retracement from point 0 to point 1 here, right, we would have seen that the trend line would have captured this market structure very well as well, right? Would have captured this market structure pretty well, right? So this is what we are trying to emphasize and highlight. So be it for an uptrend or a downtrend, Fibonacci retracements, we always go from left to right. For the uptrend, so bottom left to top right. And for the downtrend, we start the retracement from the bottom top left and we end at the bottom right. Right, and the other aspect to take note of, or the important point to take note of, is the trend line must capture the market structure as closely as possible, be it to the downside or to the upside. All right, great. Okay, let's move on to the next slide. All right, so now that we've had a quick look of how to identify ideal market structure, how to identify significant swing highs and swing lows, and also we've also seen how to draw the Fibonacci retracement in a manner that is going to give us significant retracement levels, right? We saw we have to identify significant swing lows here. You can see point 0 is a significant swing low, point 1 is a significant swing high, and point 2 is another significant swing low. And similarly, when we choose the most ideal starting and end points, the blue trend line is very likely going to capture the market structure very closely, right? So do take note of that. All right, okay, with that, now we're going to look at the various Fibonacci retracement levels. Okay, for those of you who may be aware or have used the Fibonacci retracement tool before, so we know that this goes from 0 to 100, right? 0 to 100%. Right, so the retracement levels as highlighted here, as you can see, or well, not highlighted, but as described in this image, you can see that the retracement levels run from 0% to 100%, right? So the key retracement levels are at 23%, 38.2%, 50%, the golden ratio of 61.8%, and the 78.6%. So there's 1, 2, 3, 4, 5 key retracement levels, right? So when we talk about the Fibonacci retracement levels, we're talking about the 5 key retracement levels running from 0 to 100, and they are, right, 23%, 23.6% to be precise, right, 38.2%, 50%, 61.8, which is the golden ratio, of course, and we end up with 78.6%, right? So do take note, these are the 5 key retracement levels: 1, 2, 3, 4, 5. 23.6%, 38.2%, 50%, the golden ratio 61.8%, and of course the 78.6%. Now, in this example, we have started this retracement from point 1, the starting point 1, right? And the ending point 2. So do take note, Fibonacci retrace, the starting point of the Fibonacci retracement will always indicate 100%, and the ending point will indicate 0%. So conversely, if I were to draw the Fibonacci retracement from this part here, let's just identify this swing low as 0.4. Now, let me just tidy this up a little bit. Right, let's just identify this swing low as 0.3 and this swing high as 0.4. So when I draw the Fibonacci retracement starting from 0.3 to 0.4, my starting point is going to show me 100%, and the ending point is going to show me 0%, right? Just like how we see here on this downtrend, right? On the downtrend, we start from top left and we end at bottom right. Conversely, for the uptrend, we start at bottom left and we end at the top right. So starting point is always 100% and ending point is 0%, right? And the key retracement levels, like I said, are the 5 key retracement levels at 23.6%, 38.2%, 50%, 61.8%, and 78.6%. Now, in this example, we're also showing Fibonacci levels that are greater than 100% and lower than 0%, right? So the negative retracement levels are the key retracement levels at the negative point are negative 27.2 and negative 61.8%. We'll touch on this a little later. Similarly, extension levels that are greater, Fibonacci levels that are greater than 100%, the key levels are at 127.2% as seen here, and what is not seen is at 161.8. But for now, let's just focus on the retracements, right? So 23 to 78.6, right? So as I mentioned, we started at 0.1. We started this retracement, right? We started this retracement at 0.1, 100%, and we end at 0.2, which is 0%, right? So we can only start this once the price has formed the swing low. So basically, we're waiting for price to make this significant swing low here, come up here, maybe the first after the first 1 or 2 candles or 3 candles, depending on your time frame. Let's just assume we are on the 4-hour time frame and we see 2-3 candles, at least 1 or 2 candles being formed after we see the significant swing low. That's when we can draw the retracement. So in this case, we're drawing the retracement from 0.1 to 0.2, and what the subsequent retracement levels at 23, 38, 50, 61, and 78.6, what these levels are going to highlight. These levels are what these levels are going to highlight are potential resistance levels. Do take note when we draw the Fibonacci retracement for a downtrend like this, the subsequent retracement levels are going to help us identify potential resistance levels. All right. Conversely, when we draw the Fibonacci retracement for the uptrend, right, we're going to start from 100% and at 0. What the subsequent retracement levels tells us is going to highlight to us is our potential support levels, right? So we get 23.6%, 38.2%, 50%. So for the uptrend, the retracement levels are going to highlight potential support levels, and for the downtrend, the retracement levels are going to highlight potential resistance levels. Okay, right. So as you can see here in this example, 23.6% didn't offer much resistance, right? You could see price just stalling briefly here before going higher, where it does seem to have run to resistance. Okay, then after that 38.2%, we can clearly see price breaking above 38.2% as well. Where price failed to break above is at the 50% retracement, right? Clearly, we can see a price has failed to break above the 50% retracement. So this is a major resistance for price for this current example. So we can see just because we have a retracement level at 23.6% and 38.2% does not mean that price is going to stall at this level and reverse and drop lower, right? They are just points that are going to help us identify potential, right? What is important here, they are highlighting potential resistance levels. It doesn't mean that they will act as significant resistance levels, but what the retracement levels here are going to highlight is they're highlighting potential resistance levels. So, but in this example, you can clearly see 23.6% and 38.2% did not offer any major significant resistance. Where price did stall was under the 50%. So now we know for that 50% is a significant resistance level, and is going to take something pretty like a strong catalyst for price to break above this level. All right, so do take note, the retracement levels highlight potential support or resistance. They do not indicate or they do not guarantee that these retracement levels are going to function as very significant support or resistances, right? Do take note. That's a very important, another important aspect of using the Fibonacci retracement tool. All right, okay. Moving on. All right. As I mentioned, the key retracement levels are 23, 38, 50, 61, and 78. Levels that are lower than 0. We also have Fibonacci levels that are lower than 0%, and we have Fibonacci levels that are higher than 100%. So we're going to get to those as well. All right, so the negative Fibonacci levels, right? So the negative Fibonacci levels are also known as expansion levels. You can see the key Fibonacci the key negative Fibonacci levels are negative 27% and negative 61.8%, right? These levels, these negative levels are also known as expansion levels, all right? So you may hear or come across this term, so do not be confused if you come across the term Fibonacci expansion or expansion levels, right? They simply refer to the negative retracement negative levels, which are at negative 27.2 and negative 61.8. All right. Okay. So these are the key retracement levels for the negative at the negative end, and they are also known as expansion levels. Now, how can we use this? Okay. How can we use these expansion levels? Well, first, right, you can see we started this retracement from point 1 here, and we ended at point 2, right? And we can also see 50% is here. So in order to use the negative levels, or not rather to use, but for the negative levels to provide or to function as significant support levels, we actually need to see price retrace up to at least 50 to 61.8%, right? Do take note, price must retrace, right, after forming this low here, this significant swing low here. Price must retrace to at least 50% or even better 61.8%, so that when we see a market structure like this, and then should price reverse and drop lower, breaking under the 0% or the ending point, that means that these negative levels are expansion levels at negative 27.2 and negative 61.8% Fibonacci are going to potentially function as significant support levels, right? So do take note, this is another key aspect when using the expansion levels. The Fibonacci, the market structure must retrace up to 50 to 61.8%. It must, right? So at least 50%, and then should price reverse and drop lower, breaking under the ending point, that means negative 27.2 and negative 61.8 are going to potentially function as significant support levels, okay? This is a very important aspect, because if price only retraces up to 38.2% and then stalls and reverses to drop lower, that means this levels here at negative 27, negative 61 may not offer significant support, right? Do take note. This is one key criteria, right? The key criteria is the retracement has to come up to at least 50%, right? The retracement has to come up to at least 50%. I'm talking about this retracement here, right? It has to retrace up to at least 50%, even better if it comes all the way up to 61.8. And then as it reverses to drop lower, the expansion levels are then likely to function as significant support. All right. Okay. Now, in this example, we can see clearly that price has retraced to 50 and has even reached 61.8%, right? And then has now started to reverse and drop lower. Now, so how can we use these expansion levels? First off, as price starts to retrace to drop lower, we can also use the 0%, for example, as a potential take profit level, right? So if you go short on this position here and price is reversing, right? Perhaps there's a strong bearish catalyst that has a combination of a strong bearish catalyst, and your technical analysis is telling you this is now a potential short entry, where you would identify your take profit would be potentially here at the major swing low here at 0%. And should price continue to break lower, you can identify your second TP or take profit at the negative 27.2%. So, right, this is where we can this is how we can use the negative Fibonacci levels or the expansion levels to help us identify potential take profit levels for the short side, right? So in this example, you're seeing it for the short side, for a potential short trade, right? So typically, in this scenario, price will, if price breaks below this swing low here, it will typically find support at negative 27.2%. And usually it does bounce off this level to return to 0%. So do take note. So this is how we can use the negative 27.2% Fibonacci expansion level to help us identify a potential take profit on the short side, or for the potential short trade, right? Okay. With that, okay, now we're going to look at Fibonacci levels that are greater than 100%, right? The key Fibonacci levels that are greater than that are greater than 100%, as I mentioned earlier, at 161.8 and also at 127.2%, right? These are the two key significant retracement levels. Sorry, extent levels that are greater than 100, and these levels that are greater than 100, they're also known as Fibonacci extensions. All right, do take note. Right, so if you come across the term Fibonacci extension levels, it is simply referring to levels that are greater than 100%, and they're specifically referring to 127.2% and 161.8%, right? Just like for the Fibonacci expansion levels. So similarly, if you come across the term Fibonacci expansion levels, they're referring to levels that are the negative levels, and specifically referring to negative 37.2 and negative 61.8. Okay, so expansion levels are negative, also known as the negative Fibonacci levels, also known as Fibonacci expansion levels, and the Fibonacci levels that are greater than 100% are also known as the extension levels. And the key extension levels come in at 127.2 and 161.8%. All right, so in this example here, right, we see price from this starting point here, point 1 making the swing high here, and then point 2 has made the swing low here. So how we can use the extension levels is we can use these extension levels to help us identify the take profit, a potential take profit zones. Sorry. So in this case, you can see price has made this Nike tick structure. You can see this Nike tick structure, right? We all know the company Nike and its logo, which is the tick. And you can also clearly see a price. This market structure here is following this Nike tick structure. So what we see is, or how we can use the extension levels, is when we see price reverse strongly and come back up to the starting point, which is at 100%. Here we can say we're looking for potential bullish breakout here, right? We have our technical indicators telling us that this is a strong bullish move. We also have a strong fundamental data catalyst that's driving this move as well. So we are looking for potential bullish breakout. So when price breaks above 100% here, how we can use the extension levels is we can use them to identify potential take profit. So for example, 161 here has been identified here, and 127 is probably somewhere around here. So we can use these extension levels to identify potential take profit. So this could be the second take profit zone, whereas the 127.2% would be the first take profit zone, right? So this is how we can use the extension levels to help us identify potential take profit zones should price break above the 100% or the starting point and continue to drive higher. And then from here is where you could potentially is to identify a major resistance level. And from here, you could also potentially initiate a short trade idea as well. Because when you see price failing to break above the 161.8% extension level, it is quite likely it is going to drop lower. So as price moves away from this extension level and starts to drop lower, you can initiate a short entry, and your stop loss will be placed slightly above the 161.8% Fibonacci retracement to give us a little bit of a buffer, right? To give us a little buffer. So should price retrace back to the 161% as you can see here, but because we've kept our stop loss slightly above the extension level at 161%, it allows us to remain in the trade. And should price continue to drop lower, we can benefit from this potential short trade idea as well. So you can see how the extension levels can be used to identify potential take profit zones to the upside. And then once it hits 161.8% Fibonacci retracement extension, and then it starts to pull away, you can also consider initiating a short trade idea where you put the stop loss slightly above the 161.8% Fibonacci extension. All right. Okay, great. Let's see. Right, okay. we've come to the end in terms of my slides. So what are we going to do? What we are going to do now is we are going to move over to trading view and try and find examples of how to use the Fibonacci retracement tool correctly, right? So we're going to start, of course, just start off with the basics. All right. Okay. So here I am on trading view. I'm on the 4-hour time frame, and I'm going to use the dollar index as an example. Right. So first of all, we're going to try and identify significant swing highs and swing lows. So let's just do this exercise together, right? So just to take note, when we are using Fibonacci retracement tools, they generally work better on the higher time frames, right? So they generally work better on the 1 hour time frame and above, right? You can use them on the lower time frames as well, 30 minutes, 15 minutes, but they may not offer the same level of support or resistances as when we use them on the higher time frames. So do take note uh, about this aspect of using Fibonacci retracements, right? They do tend to work better on the higher time frames, such as 1 hour and above. All right. Okay, so first of all, we do a simple exercise on trying to identify significant swings, right? As we saw in the slides earlier, right? We saw examples of insignificant swings, and now we're going to look at examples of significant swings. So this is I'm on a 4-hour time frame for the dollar index, DXY. My chart is showing the price structure from end of September all the way to present time. So I think it's quite clear by now where the significant swing lows and swing highs, right? So, right, you can see here this is a significant swing low here. Okay, maybe hang on. Right, let's start off with swing highs. We can see this is a significant swing high. This is also another significant swing high here. This is another significant swing high. This is another high. This as well. This as well here, right? So 1, 2, 3, 4, 5, 6, right? These are generally how we would identify significant swing highs, as this one here as well. So the red circles are, I'm highlighting the significant swing highs in red. And now I'm going to highlight the significant swing lows in green. So you can see here, this is a significant swing low. This is another swing low here as well. Here, 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 and of course here, right? So what we're actually trying to look for, right, is I'm going to now just use a different color. So we're going to look for significant swings, right? So you can see when price makes a very strong V-shaped move here like this, as highlighted in the orange line, right? We can see that this is a very significant V-shaped move, right? And this tells us this is a significant swing low, and this is a significant move. Similarly, right, when I draw the swing high from here, we can see this is an inverted V shape, right? We can see a very clear, significant swing high with a strong inverted V shape as well. Similarly, for this downside, we see a strong V shape here. And then for this swing high here, we can see generally the pattern I'm trying to get at. You can see that this is another inverted V. Similarly here, this is a strong V shape pattern here, swing. Another strong inverted V shape here. Another strong inverted V shape here. Strong V-shaped pattern here to signify the significant swing low. Another one here, inverted V-shape to indicate the swing high. Another strong V-shaped pattern here to indicate the swing low. And this high here, low here, high here as well. This is also a pretty significant swing low bounce here. And of course, this significant swing low over here. Right, so you can clearly see how we can identify major swing highs and swing lows, right? That's important, right? So as you can see here, I'm just going to leave this on for a bit before I erase it. So you can clearly see the green circles highlighting the significant swing lows, whereas the red circles are highlighting the significant swing highs. And you can see by my orange V shapes as well. We see an inverted V shape as well as the regular V shape that show us the size of the move, right? We're looking for significant swings and lows and highs, and the size of the move can be is highlighted by my orange brushes, right? You can see that the moves are very significant. So this is how we identify swing highs and swing lows, so that we are able to identify ideal starting and ending points for the Fibonacci retracement, right? Okay, so now I'm going to clear all of this, and I'm going to show you how we can draw the Fibonacci retracement for these on these swing highs and swing lows. All right, so we'll start with here on 29th of September and we'll end here on 3rd of October. Okay, so for those who may not be familiar with the Fibonacci retracement tool, the icon looks something like this, right? So you'll see 4 lines, and you'll have the bubble here as well, the circle here on the left and on the right. So if you highlight it, it'll show you, depending on whatever platform you're using, but if you're using a trading view, right? If you highlight over this icon here, it'll tell you Fibonacci retracement. So that's what you want to use. So we click on that, and we're going to start with the absolute low point here. Okay. So I'm just going to zoom in a little bit. Right. So I'm going to just zoom in a little bit. This is my starting point, right? So remember, for this is an uptrend. So Fibonacci retracement always goes from left to right. Since this is an uptrend, we're going to start from the bottom left and we'll end at the top right. Okay, I'm going to pull up all the Fibonacci levels here. So this gives me the negative levels, the positive levels. Remember, negative levels are called expansion levels, and levels greater than 100 are called extension levels. Okay, right. Okay, but with that, I'm just going to focus on the retracement levels in this example, right? So as not to overcomplicate things. So I'm going to get rid of the extension levels as well as the expansion levels, right? And we're just going to deal with the retracement levels going from 0 to 100%, right? So then this is much more clear. So when we draw the Fibonacci retracement from this uptrend here, bottom left to top right, and as price is coming down, these retracement levels are going to potentially are going to highlight potential support levels, right? Now, whether these levels truly function as significant support levels, we can only tell when the move plays out. But generally, it does help us to identify potential support areas. So as price has made this swing high here and started to come down, we can see that price did find decent support at a 23.6%, retracing higher before falling lower. Then again, you can see here, it did find a little briefly found support here at 38.2%, again at 50, then also pretty strong support here, 61.8%, 78, and then finally 100 down here, right? So you can see clearly in this example here, price did seem to find support at almost nearly every single retracement level. Now, this doesn't always happen to be the case, right? There, as we saw in the slides, right, there can be cases where price will just simply break through the 23, 38, maybe even the 50, and then find support at the 61.8%. So do take note, in this example here, we do see price to have clearly found support at each of the retracement levels, right? Okay, this was an example for the uptrend. Now I'm going to draw a Fibonacci retracement for the downtrend, right? So this was the uptrend, bottom left to top right. We can clearly see here, this is a strong move down. We have a nice significant swing high here on 3rd of October, and we have a significant swing low here on the 12th of October, right? So we're going to start this retracement from here. Remember, whether it's a uptrend or downtrend, we always go from left to right. So since this is a downtrend, we'll start from, hang on. We'll start from the top left and we'll end down here on the bottom right. So in this example, we can clearly see price has broken through 23, 38, and 50% very easily, right? Very easily. These retracement levels here did not offer a hint of resistance at all. Where it did finally run into resistance was at 61.8%, right? And then after that, over the next half a day or so, price briefly broke above the 61.8 as well before dropping lower. So you can see where price found major resistance in this example is at the 61.8%. Do remember over here when we did the Fibonacci retracement on this uptrend here, we could see price finding support at every single retracement level. However, for this part of the move, we can see where the the only level that offered serious resistance was at the 61.8% Fibonacci, right? So you can clearly see no two Fibonacci retracement is going to behave the same way, right? We are never going to see the same retracement level functioning as a major support or resistance, right? Every swing high and swing low, or every uptrend and downtrend is going to be different, right? So do take note of that. There's nothing set in stone with regards to the Fibonacci retracement levels. It could be a case where the retracement levels offer support or resistance at every single level, or there could be a case like what we're currently seeing, where only the 61.8% has offered significant resistance. All right. Okay. So here we can see the price running into resistance 60 at 61.8 on 12th of October, 13th of October, as well as 19th of October, right? Okay, so these were the two examples of how we can use how we can draw the Fibonacci retracement for an uptrend and downtrend. All right. Okay. Now let's move over to somewhere to where price is currently trading. Right. Let's see where price is currently trading and perform some technical analysis here using the Fibonacci retracements. All right. Okay. So once again, before we try and draw the retracements, let's do a simple exercise where we can try and identify the significant swings, right? Okay, so this is a green. All right. So we can see here, this is a pretty significant swing low here on 29th of November. Another significant swing low here on 15th of December. This significant swing low here on 28th of December. So when we look at end November till now, we can see three significant swing lows when we're on the 4-hour time frame. All right. Okay, now I'm going to try and identify significant swing highs. Right. You can see here, this portion here is a pretty significant swing high here. And over here, okay, price has not yet played out, but you can generally see the top of this wick is another significant swing high as well. Right. Okay, so let's just say, okay, let me just okay, I'm just gonna highlight my points so it's easy to refer to as well. All right, so let's work with points 1, 2, and 3 first. All right, let's work with the first 3 points. All right, so we have identified our major swing highs and swing lows. So let's just focus on the first 3 points. So for this upward trend here, we would be actually technically we would have highlighted this as 0.2 because as price was pulling down, we have highlighted this as 0.2. So we'll take this in step by step. So we'll start the retracement for this uptrend here from 0.1 to 0.2, right? You can see here in this example, as price was pulling back, 23.6% did not offer any support at all. 38.2, not really, because we can see the wick extending way beyond the 38.2 and even dipping below the 50%. So where it did find support here in this example was around the 50% Fibonacci retracement, right? As we can see here, the body of the candles actually closing underneath the 38.2%. And we can also clearly see the wick extending beyond the 50. So where price did find support in this example was at 50% before going higher. And as price comes up here, right, when a new high is made, we cannot use 0.2, the original 0.2 anymore. If we do wish to use the Fibonacci retracement, we have to move our ending point now because this is a new high. We have to move it to here. which is, yeah. And in this sense, you can see the trend line, right, is capturing the market structure quite well, right? Is not in what is not as ideal, as perfect as what we saw here at the first go. You can clearly see the trend line has captured the market structure very well. But even when it makes this second high here, you can see that the trend line has captured the market structure quite well. So we can still use this. So similarly here, 23.6% did not offer any support. Where it did find support was this time round at around the 38.2 before retracing higher and then finally smashing through all the other levels. You can clearly see here as it smashed through 38.2, 50%, 61% offered no support. Where it did find support briefly was at around the 78.6% Fibonacci retracement. All right, you can clearly see how the retracement levels help us to identify potential, right? The key word here is potential support levels or potential resistance levels, right? Nothing is set in stone. It doesn't mean price has to react off each level, but it's just helping us to identify potential support or resistance levels. Okay. Now, after price has come down here, it has found support around 100 and 190 before proceeding higher. So now we have 0.2 and 0.3. We can also run a Fibonacci retracement on this downturn. So we'll start from here, 0.2, 11th of December, going down to 0.3, which is the 14th of December. So in this case here, we can see as price was retracing higher, these retracement levels are helping us to identify potential resistance areas or zones, but we can clearly see 23.6% offered no resistance. Where it did run into resistance was around the 38.2%, right? 38.2% was where price found resistance before dropping lower. And you could see from 18th December all the way till 3rd of Jan, right? This price failed to break above this level until just recently last week. Okay, so this is how we can use the levels here. Now, as price comes down here, right, we can see now this, I would use this as let me highlight this as 0.4, right? So you can see here, this is a pretty significant swing high. This is a significant swing low. So if I were to extend this Fibonacci retracement, right, I go from 2 to 4, right, we can see that the market structure, the trend line has captured the market structure quite well, right? Quite well. Some would argue that because this has drifted too far, I would not use 0.2 as a starting point, but rather I would try and use 0.3 here, for example, this point here. Okay, here the market structure, the trend line captures the market structure a little bit better, but even here, I think to me, this is still pretty all right, right? This is still pretty all right here. You can see at this part, especially the beginning of the move, the trend line captures the market structure very well. And the second half of the move, it captures it pretty well as well. It's only this bit here. So as price is retracing higher, we can see clearly 23.6, 38.2, and 50% retracement levels offered no resistance at all. Where it did run into resistance was around the 61.8% Fibonacci retracement, right? So you can see here, these retracement levels are just going to help us identify potential resistance, but you actually have to see where price is actually going to run into, right? So you can see here, because this is also an overlap, a pretty strong resistance level here, right? As price retrace higher here in 18 December, this forms a pullback resistance, right? This forms a pullback resistance level. And you can see price actually running into resistance here on 3rd of Jan, right? It broke above 23, 38, and 50 very easily, but it actually stalled at around this resistance level here at 102.64. And also we can see how the 61.8% Fibonacci retracement has also helped us to identify another strong resistance zone above this pullback resistance. Okay. And now, okay, I'm going to label this as 0.5. So in this case, I'm going to run the Fibonacci retracement from 0.4, this swing low, ending with this high here at 0.5. Now, as price is let me get rid of this. Right now, as price climbed as high as or briefly going above 103 and then pulling back sharply, you can see that as it was falling down, 23.6% offered no resistance. 38.2 is a level where we did find a little bit of resistance, right? But actually, you can see it actually go beyond. So where it found support, where it found support was slightly above 50%, right? So the major support for the dollar index now is actually at around 102.10. And we can also see that 50% is still suggesting another strong support zone should price break underneath 102.10, right? So do take note, these are the key support and resistance levels of course, now with price breaking above it, I would have to adjust my resistance to this level here. I'm going to use the body of the candle so we can see the major resistance at 102.74 and major support at 102.10. All right. So so we've covered Fibonacci retracements today, which is part 1 of the Fibonacci series, masterclass series. Right. So do look out for part 2 coming up next week. Right. So where we will be building on retracements. Right. We covered a little bit of extensions and Fibonacci expansions today as well. Do take note, expansions are the negative levels and extensions are the levels greater than 100. We covered a little bit of that as well. And in part 2, we're going to delve a little bit more deeper into them. All right. So just to recap, today we had Fibonacci retracements. Do remember we're looking out for significant swing highs and swing lows, right? Such as these, right? We're looking out for significant swing highs and lows. Where did it go? Where's my brush? Right. Such as these, right? This is a significant swing low. This is a significant swing high. Another significant swing low. Also another significant swing low and swing high. So do take note. It is important to identify a good or ideal market structure where we can clearly see the significant swing lows and the significant swing highs, so that when we draw the Fibonacci retracement tool, we're actually going to get indication that these retracement levels are going to offer significant support or resistance. And do take note that the trend line has to capture the market structure as closely as possible. All right. Okay. So we've come to the end of today's webinar. Thank you all for tuning in. Do look out for next week's Fibonacci series part 2, right? And do register for that as well. All right. Take care. Have a great trading week and enjoy your weekend as well. All right. Thank you, everyone. And I'll see you guys next week. All right. Take care.